We are of the opinion that the Fed is, and the market is, potentially a bit overly aggressive in the number of rate hikes being priced in for this year, given the risks on the economic side.
The United States Federal Reserve has hiked interest rates by 0.25%. What are the implications on the US economy, as well as the knock-on effects it may have on asset prices? Here to discuss that and more is Kieran Siney, co-head of financial markets at ETM. Kieran, the theme of this year has been that of inflation, largely due to the stimulus measures that we saw in the Western world, as well as the supply chain dislocations. What is your analysis of yesterday's interest rate hike, as well as the knock-on effect it may have in the US economy?
So I think it's important to start with where we were in the rate cycle. We had an extremely low base coming out of COVID. Central banks across the board were injecting masses of stimulus into the financial system to support their respective economies. So we have seen the likes of the Fed and the BOE lifting their foot off the stimulus pedal in recent months, which is effectively them slowing down the pace at which they were injecting money through their respective QE programs into their economies. We've now seen them removing their foot off the accelerator and starting to apply their foot on the brake. This is done through the means of hiking interest rates. Last night, we saw the Federal Reserve implement the start of their hiking cycle. It was widely expected that the Fed was going to deliver a 25 basis point rate hike. What was of interest was Fed member Bullard did vote for a 50 basis point rate hike. This shows that there was some contemplation about potentially a more aggressive rate hike than what was being talked about.
Now, I've seen coming off the rate hike that some analysts have anticipated that there will be a slowdown in the United States economy. In fact, these were questions posed to the Fed chair, Jerome Powell. Do you anticipate to sort of see some level of slowdown in the US economy in regards to essentially demand? What would also be the impact on asset prices due to the rate hike?
So if I can start with your latter question, I think much of the rate hike and expectations for the upcoming rate hikes are already priced into the market. The Fed statement was regarded to be slightly more hawkish than what was expected. They continue to relay the message that they will lift interest rates 7 times throughout this year, which is priced into the market. So I think there was no massive surprise. We did see the dollar appreciate yesterday. However, this morning, we've seen some risk on. So this tells us that much of this hawkishness and interest rate hikes from the Fed is priced into the market. So I think where we see potential is if growth does come in softer than anticipated in the months ahead, if supply chain issues persist, if the US gets more involved in the war in Russia, there we see potential for a downside surprise in economic growth, and that will translate into potentially a slower or softer rate hiking cycle than what's being portrayed by the Fed. We are of the opinion that the Fed is, and the market is, potentially a bit overly aggressive in the number of rate hikes being priced in for this year, given the risks on the economic side. There's a lot of talk and concern about stagflation in the market. That's a situation where inflation weighs on economic growth and economic activity in an economy.
Throughout our analysis here at the CRA, we've noticed that over the years that there's only a certain point that the Fed could hike rates before you could see a contraction in asset prices, in this particular regard, I'm referring to the S&P and so forth. Do you anticipate that they're going to reach a certain level and they can't hike rates beyond that level because it will cause a contraction in asset prices?
Yes, I think it's important to note that the Fed doesn't directly look at asset prices and doesn't make its decision based on asset prices. However, indirectly, they will be looking at asset prices and the impact of their rate hiking cycle on the financial market. Again, there's still so much stimulus within the financial market and financial markets across the globe at the moment Until we've seen that unwind in the coming months with the likes of the BOE and the Fed hiking, we've also seen the ECB turn more hawkish. They've pushed out their rate hike again to 2023. There was speculation that we could see a first hike from the ECB towards the back end of this year. But with this all said, there's still a massive amount of dollar liquidity within the circulation. This is filtering into asset prices, and we still expect emerging markets to benefit from these loose or accommodative monetary conditions.
So you spoke on risk on sentiment. Do you think that this environment of hiking interest rates, and you've also touched on that there's still going to be some level of a stimulus in these Western countries, which will benefit emerging markets? So do you believe that will carry throughout the rest of the year? For example, foreign investors will continue to buy South African bonds, largely due to the high yields and the money sloshing around in Wall Street and so forth. Do you see that trend still carrying throughout the rest of this year?
So from a South African perspective, we've dubbed the Rand the mighty Rand. It's trumped a lot of expectations. And this is down to a number of fundamental, such as improving terms of trade. So although we've seen surging oil prices, the rate at which coal prices has increased has been greater than that. So that's resulted in a net benefit for South Africa's terms of trade. This comes against a weak economic background. So our import demand is relatively weak. So with the mining sector benefiting from exports and higher international commodity prices and domestic import demand still relatively weak, we expect SA's terms of trade to remain supportive of the Rand and in turn SA assets going throughout the year. SA bonds, we've seen some net outflows from foreign investors. I think this has been due to the Russian war and the risk aversion related to the war. The net outflows haven't been massive. And interestingly, we've seen some net inflows from foreign investors into SA equities, which shows that there's still value to be extracted from SA equities.
So in regards to the net outflow of foreign investors from SA bonds, particularly on bonds, which institutions then start to take up that gap? I saw that the South African Reserve Bank noted that South African commercial banks have been buying South African bonds. Do you see that trend also going through this year?
I think so. SA bonds are offering a great yield relative to other emerging market bonds available to the market. I think SA is looking like the shining star at the moment. We've seen a rotation out of Russian bonds from investors, out of Turkish bonds. I think LATAM is the only other comparable and potentially emerging Asia where there are good yields relative to the risk profile of those sovereigns.
Thank you, Kieran, for your brilliant analysis. Do also check out ETM. We now leave this to you, the viewer. What do you think the implications of monetary tightening around the world will have on emerging markets? Just a reminder that there's a lot that we do at the CRA. To get access to a range of products that we offer, please click on the link below to your 30-day free trial. Until next time, take care.